What if the next financial shock doesn't come from the stock market, but from something much bigger? Imagine a world where inflation keeps rising, the economy starts slowing down, and the traditional places people put their money suddenly stop working. In that kind of environment, investors are forced to ask a very uncomfortable question. Where can money actually be safe? Right now, many analysts believe we are moving toward a powerful economic phase called stagflation. And if that happens, gold and silver could become some of the most important assets in the global financial system. Welcome to Gold Silver Scope, where we break down the biggest developments in the gold and silver markets and explain what they could mean for investors around the world. To understand why precious metals are suddenly getting so much attention again, we first need to understand what stagflation really means. Stagflation is a very unusual economic condition where inflation keeps rising, but economic growth slows down at the same time. Normally, when inflation rises, the economy is strong. But in a stagflation environment, the opposite happens. Prices continue to rise while economic activity weakens. One of the most important indicators in this situation is something called real yields. Real yield is simply the return you earn on something like a government bond after subtracting inflation. For example, imagine government bonds are paying around 3.7% interest, while inflation is running around 3%. The gap between those two numbers is already very small. But if inflation starts rising faster, that gap becomes even smaller. Eventually, something critical can happen. Inflation may rise above the interest rate being paid on bonds. When that happens, the real yield becomes negative. That means investors are actually losing purchasing power by holding bonds. In other words, the money they earn in interest cannot keep up with the rising cost of living. This situation creates a very difficult environment for investors. Normally, people have several options when deciding where to put their money. They can invest in stocks, they can buy bonds, or they can move into other assets. But during stagflation, many of these options become much less attractive. Stocks usually struggle during economic slowdowns because corporate profits start to fall. Companies sell fewer products, earnings expectations decline, and investors become more cautious. Even if profits have not dropped yet, the market often anticipates the slowdown before it becomes visible in the data. At the same time, bonds also become less attractive because rising inflation reduces the real return investors receive. So, if stocks are struggling and bonds are losing purchasing power, investors begin searching for something that can protect their wealth. This is exactly where gold and silver start entering the conversation. Precious metals have historically been viewed as a form of financial insurance. They are not tied to the performance of any company, and they are not directly dependent on government currencies. Instead, their value often increases when investors begin to lose confidence in traditional financial assets. Another important factor that is starting to influence the precious metals market is energy costs. Mining gold and silver requires large amounts of energy. From operating heavy equipment to processing raw ore, energy plays a major role in the cost of production. Recently, energy prices have been rising significantly in many parts of the world. This naturally increases the operating costs for mining companies. At first glance, some people might assume higher energy costs could reduce production, but in reality, the situation is often more complex. When the price of gold and silver rises significantly, mining companies have a strong incentive to keep their operations running at full capacity. Even if electricity or fuel becomes more expensive, the higher market price for the metals can still make production highly profitable. Over the past several years, we have already seen major price movements in precious metals. Gold has experienced significant appreciation, while silver has seen even stronger percentage increases during certain periods. Because of this, most mining companies are focused on maximizing output rather than slowing down production. However, production is only one side of the equation. The other side is demand, And this is where the silver market becomes particularly interesting. Unlike gold, which is mainly held as a store of value, silver has a very large industrial role. It is used in electronics, solar panels, electric vehicles, medical equipment, and many other modern technologies. Because silver has unique electrical and thermal properties, it is extremely difficult to replace in many of these applications. This means that industrial demand for silver continues to grow as technology expands. Every smartphone, solar panel, and advanced electronic system requires small amounts of silver. Individually, these amounts are tiny, but when multiplied across millions or even billions of devices, the total demand becomes enormous. In fact, something very important has been happening in the silver market over the past several years. Global demand for silver has actually started exceeding the amount being mined each year. This means the world has been consuming more silver than miners are producing. When that happens, the difference must come from somewhere. It usually comes from recycled silver, existing inventories, or investors selling their physical metal holdings. But if demand keeps growing faster than supply, eventually the market must adjust through price. And that is exactly why many analysts believe the precious metals market may be entering a very important phase. Because when supply remains limited, demand keeps rising, and financial conditions become unstable at the same time. History shows that gold and silver can react very strongly. And right now, several of those conditions appear to be developing at the same time. Now, when we look deeper into the silver market, something very interesting starts to appear. Earlier this year, silver experienced a very sharp price movement that surprised many investors. For a short period, the price surged rapidly and created a lot of speculation about what was happening behind the scenes. At the time, many people were trying to understand the reason for this sudden move. But as more information started to appear, it became clearer that something unusual was taking place in the futures market. Large industrial buyers of silver, including manufacturers involved in electronics, solar energy, automobiles, and other high-technology industries, suddenly became more aggressive in securing their supply. These industries rely heavily on silver for production, and without a stable supply, their entire manufacturing process could be disrupted. Because of this risk, many of these companies began moving their futures contracts forward so they could take physical delivery of silver sooner rather than later. Instead of waiting months for delivery, they pushed their contracts into earlier months and requested the metal immediately. This sudden demand for physical silver created pressure in the market. When a large number of buyers all try to secure physical metal at the same time, it can cause what traders call a squeeze. Sellers who expected to deliver metal later suddenly find themselves needing to deliver it immediately. When that happens, prices can spike quickly because the available supply becomes extremely tight. However, after that initial surge, the market began to stabilize again. As we moved into the following months, the number of delivery requests started to decline. At first glance, this might look like demand was falling, but the real explanation is slightly different. Many of the manufacturers who rushed to secure silver earlier had already built up inventories. In other words, they had stockpiled the metal they needed to continue production for a period of time. Once they had enough supply in storage, they no longer needed to take delivery immediately. Instead, they began rolling their futures contracts into later months again, which temporarily reduced the number of deliveries taking place in the market. But this does not mean the long-term situation has changed. One of the most important indicators analysts are watching closely is the amount of silver stored in major exchange warehouses. These warehouses hold physical metal that backs the futures market and allows traders to take delivery when contracts expire. Over time, something very clear has been happening. The amount of silver held in these storage facilities has been declining steadily. Week after week, the inventories have been dropping as metal continues to leave the warehouses. This silver is not disappearing. It is simply moving into the hands of industrial users, manufacturers, and investors who need the metal for production or long-term storage. When warehouse inventories keep falling, while industrial demand remains strong, it creates a very tight supply situation. And historically, tight supply situations have often led to strong price movements in commodity markets. Another reason the silver market behaves differently from many other commodities is the unique structure of its supply and demand. On the supply side, most silver is not mined as the primary metal. Instead, it is produced as a byproduct of mining other metals such as copper, lead, and zinc. That means silver production does not respond quickly to changes in price. Even if the price of silver rises significantly, mining companies cannot suddenly increase production overnight because silver is not the main metal they are targeting. Production decisions are usually based on the economics of the primary metals being mined. This makes silver supply relatively inflexible. On the demand side, silver consumption is also extremely difficult to reduce. The reason is that the amount of silver used in most manufactured products is very small compared to the total value of the product. For example, a smartphone or electronic device may contain only a tiny fraction of an ounce of silver. Even if the price of silver were to rise dramatically, the additional cost per device would still be very small. The same applies to many other industries. A modern vehicle may contain around an ounce or slightly more of silver in various electronic systems. When the total cost of a car is tens of thousands of dollars, the price of that small amount of silver does not significantly affect the overall production cost. Because of this, manufacturers rarely redesign their products to eliminate silver. The cost savings simply are not large enough to justify changing the entire production process. So what we end up with is a market where supply cannot easily increase and demand cannot easily decrease. This creates a structural imbalance that can build pressure over time. For several years now, global silver consumption has been exceeding annual mine production. The world has been using more silver than it produces each year, creating a supply deficit that has slowly been growing larger. To fill this gap, the market has relied on recycled silver and the release of existing inventories held by investors or institutions. But these sources are not unlimited. Eventually, the market must reach a point where the price adjusts high enough to encourage more selling or recycling of existing silver holdings. This is how commodity markets rebalance themselves. And this is why many analysts believe the silver market may be approaching a critical phase where supply deficits, industrial demand, and tightening inventories could begin pushing prices much higher. But silver is only part of the story. There is another metal that plays an even bigger role in global finance, and that metal is gold. Unlike silver, gold is not primarily used for industry. Instead, it functions as a form of monetary insurance. And right now, the global financial system may be entering a period where that insurance becomes extremely valuable. Now let's talk about the bigger picture, because the story of precious metals is not only about supply and demand, it is also about trust in the financial system. For many years, people mainly viewed gold as an inflation hedge. When prices rise, gold tends to protect purchasing power. But today, the conversation is starting to change. Investors are no longer only worried about inflation. Many are starting to ask a much deeper question. What happens if the financial system itself begins to face serious pressure? Around the world, government debt has been rising rapidly. Many countries are borrowing more money every year just to keep their economies running. As debt grows larger and larger, governments must issue more bonds to raise the money they need. But there is a limit to how much debt investors are willing to buy. If the supply of government bonds becomes too large, the market can begin to struggle to absorb it. When that happens, bond yields start rising because investors demand higher returns to compensate for the increasing risk. We are already seeing signs of this in several bond markets. Yields have been rising instead of falling, which suggests investors are becoming more concerned about inflation and long-term debt sustainability. When governments face this type of pressure, central banks often step in to stabilize the system. One of the main tools they use is buying government bonds themselves. This process is sometimes called quantitative easing, but in simple terms it means the central bank creates new money and uses it to purchase government debt. When a central bank buys bonds, it expands its balance sheet and injects new liquidity into the financial system. But this also increases the amount of money circulating in the economy. And when more money is created while the supply of goods and services does not increase at the same pace, inflationary pressure can build. This is why many analysts believe the current environment could gradually move towards stagflation. Economic growth begins to slow, but inflation remains elevated or even starts rising again. In this situation, traditional financial assets often struggle to perform well. Another factor adding pressure to the system is geopolitical tension and global supply disruptions. When major trade routes or energy corridors face instability, energy prices can rise quickly. Higher energy costs affect almost every sector of the economy, from transportation to manufacturing. As energy prices rise, production costs increase, which can push inflation even higher. At the same time, higher costs can slow economic activity because businesses and consumers are forced to spend more just to maintain basic operations. This combination of rising costs and slowing growth is exactly what defines a stagflation environment. In such periods, investors historically begin searching for assets that are not directly tied to government currencies or financial institutions. Gold has played this role for thousands of years because it is a tangible asset with limited supply. Central banks themselves appear to recognize this. In recent years, many central banks around the world have been increasing their gold reserves. Instead of holding only government bonds, they are gradually adjusting the balance of their reserves to include more precious metals. This shift may still be relatively small compared to the total size of global financial markets, but the direction is important. When governments and central banks begin increasing their gold holdings, it often signals a growing desire for financial security and diversification. For individual investors, the same logic can apply. Gold and silver are often viewed as forms of financial insurance rather than traditional investments. They do not rely on corporate profits or government policies in the same way stocks and bonds do. That is why during periods of economic uncertainty, precious metals often attract increasing attention. And when multiple forces come together at the same time, tight silver supply, rising industrial demand, growing government debt, and the possibility of stagflation, the precious metals market can move very quickly. History has shown that gold and silver sometimes remain quiet for long periods, but when conditions change, they can react with powerful price movements in a relatively short amount of time. This is why many analysts are watching the current environment very closely. The combination of economic uncertainty, rising inflation risks, and tightening supply in the silver market could create the conditions for significant volatility in precious metals. If you want to stay informed about the latest developments in the gold and silver markets, make sure you follow Gold Silver Scope, where we break down complex financial trends into simple insights that help you understand what is really happening in the world of precious metals. And if you found this analysis helpful, consider supporting the channel by liking the video and subscribing for more deep dives into gold, silver, and the global economy. Finally, a quick reminder. This content is for educational and informational purposes only. It should not be considered financial or investment advice. Always do your own research and consult a professional before making any financial decisions. Thank you for watching, and we will see you in the next analysis on Gold Silver Scope.